Hi class. Today what we're going to do is we're going to go ahead and we're going to go through some more transactions and financial statements. We're going to start with a problem that will be similar to your next homework problem assignments. This also is very similar to what we did last week. So this is going to be kind of a repeat for you to get you to make sure that you understand how to do financial transactions, how to record them through the accounting equation. So if you'll bear with me just a minute, I'm going to share with you my Cengage screen. And let me move this out of the way so you can see a little bit better what we're going to be doing here. I'll throw it over to the side for just a moment. I want to make sure that you can see everything on this screen. I want to remind you that if you're having trouble with any of these, you can go straight to your ebook by clicking on this tab. It'll take you to the ebook. Or if you want to use a calculator, you can click on this tab and the calculator will come up. Also, if you want to print an item, you can print an item from here if you prefer to work this out by hand. All right, in this particular problem, we're going to be working with transactions first, and then we're going to prepare the financial statements from those transactions. You'll remember that we've been recording business transactions through the accounting equation. We have to do that first, and usually we do these by date, but in this case, our problem only gives us A, B, C, D, all the way through I here, but usually each one of these business transactions has a date on it because you want to make sure you record all your business transactions for a period of time. This period of time is going to be beginning in the month of April. On April the 1st, 2019, Maria Adams established Custom Realty. Maria completed the following transactions during the month of April. And so this is a brand new business, and in order to start a brand new business, we have to have some cash to operate the business with. Remember that when we are preparing transactions, we prepare them only from the business's point of view. As you can see here, our accounting equation is assets equal liabilities plus owner's equity. This is one form of the accounting equation that you can use to solve business transactions. On this first transaction, A, we are opening a business bank account with a deposit of $24,000. That means that our business's cash has gone up by $24,000. So I'm going to record underneath the cash account that my cash has increased by $24,000. And that means that my cash, which is an asset, is going up by the amount of $24,000. In every transaction, the accounting equation must balance. So you have to have two parts for every single transaction. In the transaction for A, the first part was an increase to our cash account. The second part of this is that we need to record that our owner, Maria Adams, her capital has increased. The reason for this is that she has made an investment into this business, and investments, owner's investments, will increase the owner's worth. And so the owner's equity, which is sometimes called the capital account, we will use the capital account for recording all owners' investments for the company. So underneath Maria Adams' capital, I'm going to record $24,000. What this does for transaction A is it signals that your assets increased by $24,000. And on the other side of the equation, your owner's equity went up by $24,000. After each transaction, your transaction should balance out in the accounting equation. meaning that the left side must equal the right side. So in this case, the left side, the asset side, has increased by $24,000, and it's equal to the right side because the owner's equity, which is capital, the owner's investment, increased the owner's equity to $24,000. So owner's equity now is $24,000 and my assets are $24,000. This will balance the transaction. On the next transaction, we paid rent on office and equipment for the month of $3,600. Anytime you pay out your cash will be decreasing. So anytime you see the word paid, it signals to you that the cash is going down. To show decreases in our accounts, and by the way, the cash is an account, as is supplies and accounts payable, so on and so forth, all the way across here. Accounts are places where we record increases and decreases. So when we pay out our cash is decreasing by $3,600. Now, the reason that we paid out that cash was because we paid rent on our office and our equipment for this particular month. So we're going to go over into the rent expense. Underneath it, we're going to record that rent expenses will decrease our owner's equity by $3,800. And my cash is going down, which is an asset, which makes my left side of the accounting equation go down by $3,800. My right side is also going down because my owner's equity is decreasing because we paid out an expense. Remember, there are four things that will affect owner's equity. They are the owner's investment, which we record under capital, which happened in the A transaction, but not in the B transaction. There are increases to owner's equity for revenue. And again, this was not a revenue type of transaction here. There are decreases for our expenses. Notice all of these have decrease signs in front of them, meaning that the owner's equity is decreasing. And in this case, our rent expense made the owner's equity go down by $3,800, the amount that we paid for that rent expense. So that's why we put it on this side here. The other thing that will affect owner's equity is our drawing, and it is also sometimes called a withdrawal, and it will always decrease owner's equity. Drawing and withdrawals will decrease your owner's equity. So this transaction's in balance because my assets went down by $3,800 and my rent expense made our owner's equity go down by $3,800. They're asking you to balance the account. You can see here where it says balance the account. And so what we're going to do is we're going to balance this account. So I'm going to pick up my calculator because I find it to be helpful. And I'm going to start with my cash account, which had originally in there $24,000 that the owner made as an investment. But now we're decreasing that cash by the amount that was paid out for the rent. And so we only have $20,200 left in our cash account. We didn't do anything to our supplies or our accounts payable yet. We're going to bring down the amount that we have as the owner's investment, which is $24,000. And we're going to bring down our rent expense, which is a decrease of $3,800. Or excuse me, the owner's equity is a decrease of $3,800 because of the rent expense. Expenses will decrease the owner's equity. And so it's always a good idea to check your work to make sure that you're on the right track. So I would suggest that you check your work. And as you can see here, I got a problem here already. And maybe you caught this, but I didn't. So Now I know I've got something wrong with this transaction. I better go back and read carefully. Do you see here that it's 3,600 and not 3,800? So I'm going to just change this to 3,600. And I'm going to change this to 3,600. And then I'm going to restate my balances. So my cash account should have a balance of 20,400 after this transaction. And my rent expense should have a balance of 3,600. Okay, so now we're on the right track. So I can go on to Part C. Forgive me for scrolling back and forth here. Here we go. In Part C, we paid automobile expenses, including the rental charge for the month of $1,350 and miscellaneous expenses of $600. First of all, the key word there is paid. Anytime you pay out your money, your cash is going to decrease. We're going to decrease it by the total of our expenses, which we had a rental charge of for the automobile at $1,350, or we had an automobile expense at $1,350. And we had expenses, miscellaneous expenses of $600. You combine both of these together to get $1,950. And then I'll move over to my automobile expense, which affects my owner's equity, and I'll plug in $1,350. And then I'll go right on over to my miscellaneous expense and I'll put in $600. And in order for these to be right, now you're gonna have to put a minus sign in front of them. So don't forget that. I know it's easy to do, but don't forget your minus signs or it will mark it wrong. So let's just check our work and make sure we're on the right track. And as you can see here, we are. So I'm going to rebalance my accounts now, starting with cash that had a balance before this transaction of 20,400. I'm going to subtract 1,950 from that. And what I have remaining in cash is 18,450. I'm going to bring my balance down for my capital account because I didn't do anything to it in this transaction. I'm going to bring my balance down for my rent expense and automobile expense. $1,350 was what they had for that transaction, and $600 for the miscellaneous. All right, in the D transaction, we have purchased office supplies on account. First of all, it tells us that we are buying office supplies. So we now have more supplies than we had before. So supplies is an asset account. It's technically a paid expense, but we record it as an asset when we purchase this account. We bought supplies, so it goes in the asset account to start with. The amount of supplies we bought was $1,200. My supplies account is going to increase by $1,200. Now it tells us that we bought these office supplies on account. That's a big hint there, that on account is. It's on account that we did not pay cash for it right then. We didn't have the money to do that. So we put it on credit. And our account payable is a creditor account that fits under the liability section. And the amount that you owe to your creditors is going up in this situation. So I'm going to increase my accounts payable account by $1,200. So what this means is my assets went up by $1,200 and my liabilities increased on the right side of the accounting equation by $1,200. We didn't do anything to our owner's equity. The only things that will affect owner's equity are your owner's investment, which we record as capital, our revenue, which would be sales commissions in this case, our expenses, and our drawing, which will decrease the owner's equity. None of those were affected in transaction D. The only thing that was affected is that our liabilities went up and our assets went up. So our transaction is in balance, and we'll go ahead and rebalance these accounts. So since we didn't do anything to our cash, we're just pulling it down. We now have a balance in the cash account of $18,450. We now have supplies on hand as an asset of $1,200. We also owe our creditors $1,200. Our owner still has an investment of $24,000. They still have expenses for this period for rent expense, $3,600. For automobile expense, $1,350, and for your miscellaneous expense, $600. Check my works to make sure my balances are correct. And I'm gonna scroll back up, see how well we did. And I see check marks everywhere, so that's a good thing. So I'm gonna, let's see if I can move this thing somewhere else. Can't seem to get it out of the way today. It's aggravating me. Okay, but anyway, let's move on to our next transaction. And our next transaction is transaction E. In transaction E, we earned sales commissions. Notice they've told you that the sales commissions are revenue to us. The revenue is the work that we do in our company. It's how we have the right to charge a customer some money. So in this case, we're earning some type of sales commissions. That's going to be our revenue account. And it's from selling the real estate. We actually receive cash. These are the key words right here. Whenever you receive cash, your cash account is increasing. So I'm gonna move to underneath the cash category, and I'm gonna put down the amount that it increased by, which was $19,800. Our sales commissions was also increased, or will also increase our owner's equity. So $19,800 will be an increase in owner's equity. And that's how we would record this transaction. We're still in balance because my assets on the left-hand side increased, and my sales commissions, which is revenue, will increase the owner's equity. My owner's equity increased by $19,800. To balance the cash account, we'll start with the balance that was before this transaction at $18,450. We're going to add to it $19,800. And that will give you 38,250. Bring down your other account balances as they were. The next transaction is going to be your F transaction, and we have paid the creditor on account. Anytime you see the word paid, your cash is decreasing. We're going to decrease cash by $750. So I'm going to go to transaction F. I'm going to put in a minus of $750. And then I'm going to move over to my liabilities and I'm going to decrease them. Notice we didn't pay the entire liability off, but we paid part of it. And so what this transaction did is our assets went down by 750, and my liabilities on the other side of the accounting equation also went down by 750. We are in balance. And then I'm going to subtract 750 from my previous balance in my cash account, and that will leave me with 37,500 in the cash account. 1,200 would be brought down, and then our liabilities before the transaction was 1,200. We're going to subtract what we paid toward those liabilities, so the remaining liability that we still owe is $450. Bring down your other account balances. And then we're ready to do G. Again, we are paying our office salaries, so our cash is going to go down by the amount we paid our office folks. You must show it as a decrease, so don't forget to do that. And then we're paying for our salaries, which is an expense which will affect owner's equity. Our expenses will decrease owner's equity by $2,500. Our cash balance before the transaction minus this balance. Just bring down your balances. And check your work. You don't want to go any further if you're out of balance. So it looks like we're in good shape so far. And then in H, we withdrew cash for personal use. First of all, when you withdraw cash, it should signal to you that your cash is going down. And it's going down by the amount, sorry about that. It's going down by the amount of 3,500. So for H, I'm going to put down a minus 3,500 in my cash account. And our cash went down because the owner had personal use or used that cash for personal use. And so the owner actually has to take it completely out of the business. We call it a withdrawal or drawing, and it will affect owner's equity. So under your drawing account, you have a minus 3,500 to show that the drawing will decrease the owner's equity. So my assets went down on the left side, my owner's equity went down on the right side, and we are in balance. Now rebalance after these transactions. Our beginning cash balance before this transaction was 35,000. We're going to subtract 3,500 from that, and that's going to leave us with a new balance in the cash account of 31,500. Bring down your other account balances as they are. And check your work. And then we'll scroll back up to the I transaction. And on this one, it says we're determining that the cost of the supplies on hand is $300 now. And you can see we originally bought the supplies for $1,200. And what that means now is what we have left over is $300. And then it says, therefore, the cost of supplies used was $900. If you subtract $300 from $1,200, it will leave you with $900. That's how they got the $900 amount there. The $900 amount is going to decrease our supplies, our asset account, because we've used up this $900 worth of supplies. They're no longer there. So what they become is supplies expense. And so your supplies expense is this last one out here, out toward the end. You're going to put down a negative 900 here because your owner's equity is decreasing by $900 because there was supplies expense. Expenses will decrease owner's equity. And then you're going to rebalance after the transactions. We didn't do anything to our cash account this time. We're going to subtract the 900 from the 1,200, and that'll leave us with 300 that's left over in supplies. That's what you still have left over. You're going to bring down your liability that you still owe, $450. The owner's investment did not change at $24,000. The drawing did not change in this transaction. It's still $3,500 for this month. $19,800 is still the revenue for this month. $3,600 is still the total of the rent expense for this month. $2,500 is still the total of salaries expense for this month. $1,350 is the automobile expense for this month. $900 is the supplies expense for this month. And $600 is the miscellaneous expense for this month. All right, so as an accounting process, what you're doing is you're keeping track of all the transactions that happened for the month. So all these transactions happened. At the end of the month, we summarize this information by balance accounts. These ending balances are what we have left over in these accounts. From this analysis of the accounting equation, you can then prepare your financial reports, which we will always start with our income statement. On the income statement, you're going to find two types of accounts. They are the revenue accounts and the expense accounts for the company. So in the first drop-down blank here, what I'm going to record is that I have some sales commissions as my revenue. That's the name of my revenue. And what I want to do is I want to pick up the total of my revenue account. So see, here's your here's your sales commissions. The total amount down here, the last balance of $19,800 is what I want to pick up here. So let me also caution you, when you're doing an income statement, you need to prepare a heading. And in this heading, we'll always have the name of the company, the statement that you're preparing, and the time period that this statement is going to be prepared for. Your income statement is always prepared for a period of time. We want to measure all of the revenue during this period of time with all of the expenses during this period of time so that we can net them out and tell whether we had a net profit or net income or whether we had net loss. So when you're determining your net income, you always start with your revenue first. The type of accounts that go on the income statement are revenues and expenses. These are the only ones that you'll record on the income statement. The income statement is always the first financial statement that we prepare because the ending balance on this income statement is going to be fed into the next accounting statement, which will be your statement of owner's equity. So financial statements are prepared in order. Income statement first, statement of owner's equity next, then our balance sheet. And last, we would do a statement of cash flows, which they haven't asked us to do yet. And so we're just going to be looking at the income statement, the statement of owner's equity, and the balance sheet. Those are the most important ones to me. But I guess it is also important that you know that there's one more, which will be the statement of cash flows that we talk about just briefly, but not for any length of time. I want you to really concentrate on what goes into the income statement, what goes into the statement of owner's equity, what goes into the balance sheet. These are very important. Your expenses are all listed separately, and usually we start with our highest expense first, but technically to me it really doesn't matter. Just look for your expenses and put those down. In this case, I have drop-down lists to show me what to do. So from this, I'll pull out my expense account, which is rent expense, which is $3,600, and I'm going to put it in as $3,600. Notice it's a positive amount here because expenses are really positive. The total of the expenses will decrease the owner's equity. That's why we entered it as a negative up here. But the total of the expenses is really positive. The total of each individual expense is positive. So rent expense has a positive amount associated with it of $3,600. This is how much we've spent on rent expense. In the next statement, we'll show that the total of these expenses, when netted with the revenue, they'll feed into the statement of owner's equity. And that will be either positive or negative, depending on whether there is net income or a net loss. The next expense that we're going to be looking for is the next one on our list, which is salary expense. Salary expense, if you'll follow it all the way to the bottom of the column, the last balance was $2,500. So that's the amount of the salary expense, $2,500. The next expense on our accounting equation is automobile expense. The total amount of automobile expense was $1,350, and that's what goes next on the income statement. The next expense is supplies expense. The total of supplies expense is $900. The next expense we're going to list is miscellaneous expense. The total of miscellaneous expense is $600. Now notice that each one of these expenses has the title expense on it. So rent expense, salary expense, automobile expense, all of these have expenses on the end of them. So you'll know that they're expenses. List each one of your expenses separately, and then we're going to total the expenses up. By totaling them up, we're just going to add this column up here. So we're going to begin with $3,600 for a rent expense. We're going to add to it $2,500 for our salaries, $1,350 for the automobile, $900 for the supplies expense, and $600 for the miscellaneous expense. And if I've added all those right, the total should be $8,950. And it's always a good idea to check your work. So let's check our work here, see how well we did. Okay, we're doing fine now. What you have to remember about the income statement is that you're going to compare the total of your revenue to your total of your expenses. If your revenue is larger than your expenses, as it is in this case, we have a positive amount for a net figure, which we call net income. Sometimes that's referred to as net profit, but in this textbook, they refer to it as net income. Net income is a good thing because net income will add to your owner's equity. So what we're going to do is we're going to subtract the total expenses from the total of our revenue. My total revenue was $19,800. I'm going to subtract out $8,950 in total expenses, and that leaves me with a positive $10,850. Check your work, because your net income is going to feed into the next statement. That's why we did it first. We're going to feed it right on into the statement of owner's equity, which is what they're wanting us to prepare next. A lot of times what students will ask me, and they'll say, well, these are a lot of expenses. Do I always have to list each expense separately? And the answer to that is yes, you must list them separately on the income statement. Management would be really interested in knowing how much they've spent on these types of expenses. That will give them a way to control their operations. So net income is a good thing because net income will add to the owner's equity. Notice we're really summarizing part of our accounting equation from above. We're taking all of our revenue and all of our expenses and summarizing them and saying that we had net income on our first report, the income statement. The second report that we're going to work with is the statement of owner's equity. Now you want to be careful on your statement of owner's equity. on the first line of the statement of owner's equity, we should have the beginning balance, which would be equal to Maria's capital on April the 1st, 2019. Now, in this situation, this was a brand new company that was established on April the 1st. There was no previous owner's equity to bring forward into this period. So we're starting with 0 here in our owner's equity calculations. And then we need to show that this owner made an investment on April the 1st. If you'll remember, when we go back to our transactions, we opened a business bank account with a deposit of $24,000. That's where it affected Maria Adams' capital. We had an increase in her capital because the owner made an investment. That's the only time she invested during this month, that one time at the beginning of the month. And so her total investments are $24,000 for this period of time. And you can check your work as you go if you want to. And you can see we're on the right track. Think about, in the statement of owner's equity, the things that will affect owner's equity. They would be the owner's investments. The revenue will add to owner's equity as the expenses will decrease owner's equity. Remember that you've already reported those in the income statement. There would be no need to put all this down separately. So we're going to pick up the net amount of the income, and since it was positive, it's going to add to our owner's equity. So on this next line, we're going to add the net income for April, which came from the income statement that we prepared earlier, where we summarized our revenues and our expenses and combined everything together to net them amount, net out your expenses against your revenue, and we had a positive amount of $10,850. So that's what's going to go next. Check your work. You can see we're still on the right track here. So in the statement of owner's equity, we're going to find the owner's original investment of $24,000. We're going to find whether or not they had a net income, or it could have been a net loss. If it was a net loss here, we would have deducted the net income. And then what we're going to do is we're going to put in our withdrawals. The withdrawals for this period of time are what the owner took out of the business for personal use. We call that drawing. So sometimes that says less drawing there. The total amount of the drawing for this period of time was $3,500. So $3,500 goes here. And I'm going to check my work. And then on the next part, we're just going to find out what happened through this period of time, whether we had an increase or a decrease in owner's equity. So you can see we have 2 increases here for $24,000 for the owner's investment and net income, which will increase owner's equity of $10,850. Then we would subtract out our withdrawals. So watch what I do here carefully. I'm going to take $24,000. I'm going to add to it $10,850. And I'm going to subtract out from it $3,500. And that means that we had an overall increase in owner's equity because our positives were more than our minus right here. The amount of the increase is $31,350. And again, I would check my work because you will make sure that that increase is correct. And then the last thing that we're going to do is we're going to find the ending amount of owner's equity as of the end of this month. The ending owner's equity is referred to as Maria Adams, our owner's name, capital, and make sure you pick April 30th this time. There's a difference between the beginning owner's equity and the ending owner's equity. In the beginning, we had no owner's equity because this was a brand new business. Then we combined the amounts together here to determine that we had an increase in owner's equity, which would be added to the beginning owner's equity, which means that our ending owner's equity is equal to $31,350. Now, again, your statement of owner's equity begins with a heading. Notice this heading is the same as it was for the income statement. We're preparing the statement of owner's equity for a period of time for the month ended April 30th. This is from the beginning of the month that we're going to measure the owner's equity all the way to the end of the month. So this owner has grown in worth to $31,350 at the end of the month. Next year or next month, when we start our statement of owner's equity, this $31,350 will become the beginning owner's equity next period. The owner's equity we carry forward from one period to the next. The last statement that we're going to prepare in this problem is the balance sheet. Notice the balance sheet heading only has the date listed. It doesn't have for the month ended. The reason for that is the balance sheet is done for 1 day and 1 day only. It's a picture or a snapshot of the company's financial condition as of April 30th, 2019. On the balance sheet, we have a restatement of the accounting equation. Notice we have assets that we're going to list, liabilities that we're going to list, and owner's equity. Only the ending part shows up here. I really want to emphasize that this is just the amount from the statement of owner's equity. The ending balance is the only thing that goes here. So we'll start by listing our assets first. So if we refer back to our accounting equation, we only had two assets. We had cash and supplies. Cash has a balance of $31,500. It's our number one asset. We always list it first on the balance sheet. So from my drop-down list, I'm going to choose cash, and I'm going to put in the ending balance, which was $31,500 from our accounting equation transactions. The next type of asset that we have left is supplies. What we have left of supplies at the end of the accounting period is $300 worth. So that's my asset that I'm going to call supplies. And then we're going to total our assets. And then we'll move on to our liabilities. Our liabilities, we only had one. We called it accounts payable. We're going to scroll all the way down here, pick up the ending balance of accounts payable, which is $450. So accounts payable, go next at $450. Then we're going to put in only the ending owner's equity goes into the owner's equity section here. Notice we're calling it Maria Adams Capital. That's another name for owner's equity, but we only want what happened on April 30th. We only want the ending balance from the statement of owner's equity, $31,350. And then the last part of the balance sheet, we're going to total our liabilities and our owner's equity together. So this 450 is going to be added to the 31,350, and it should give you 31,800 if we've done everything properly. Make sure you check your work, and you can see that everything has balanced out. In other words, my total liabilities and my total owner's equity have to equal my total assets. Remember, after every transaction, that accounting equation has to balance. But at the end of the month, all of the accounts that go into the accounting equation still have to balance. And we report that in the form of a balance sheet. The balance sheet is just a restatement of the accounting equation. And so that's all I've got for you today. This should be a little bit of a review for you now. I know that a lot of you are practicing a lot, and I sure do appreciate that. The more you practice, the better off you're going to be. So on this particular problem that I've assigned for you for Friday, you will have another problem that you have to do with it. But the next problem is going to be, I think it was, hold on a minute, let me look, check and see. It was 1-5A. So what I've had is some questions about how would I get to 1-5A. When you do your homework assignment, start with the first one and finish it, and then click on the second assignment and start it and finish it. Finish both of the problems before you submit your work. Remember, your submit button is down here. Do not select it until you are completely finished with both problems. You can save and exit at any time that you want to, and you can come back to the work that you've already got saved. But if you hit submit, it's gone. And you can redo these problems again, but you'll have to start all over from scratch. Now, I don't want you to do that. So just be sure and hit save and exit until you're completely through with the problem. Once you are completely finished with both assignments, click submit. I hope that clears up some things for you today. I will stop sharing now, and we'll see you later. Bye-bye.